Hello, everyone, and thank you for joining us today on the Dairy Signal. We have a really perfectly timed topic for you here this afternoon as we talk about Cull Cow LRP. And joining us today, we are joined by none other than Will Babler, who's a principal with Pinion Risk Management and Atten Babler Risk Management. So, Will, I am so excited to have you back on. It's been a minute, and I think the last time you were on, we were actually talking about the beef side of LRP. But now, and I think touched a little bit on cull cows, if I was correct on that. But now we're really just going to dive into the cull cow side of things. And gosh, it's got an interesting story to tell here and a lot of opportunity for dairy producers. So got a lot to get going on today. But between when we last saw you and for those who might be joining us for the first time, would you mind giving a little bit of introduction about yourself?
Yeah, you bet, Amber. I'll do the short version and then we'll get into the more exciting stuff around what's going on in the cattle market and how it's helping out all of our dairy clients to drive some more revenue. So real quick, Will Babler and principal with Pinion Risk Management. We're a nationwide risk management firm working with the entire ag supply chain. My area is really focusing on dairy and been doing that for 20 plus years. We've got a big team with our main offices on the risk management side here in Galena, Illinois, also in Glenwood, Minnesota, Silver Lake, Kansas, and then a growing group out in the Northeast in New York. We've cover kind of all the bases on grain, beef, and dairy. And I show this picture because it's a little bit about me. This is where I grew up on a dairy farm there in Southwest Wisconsin. You can see a couple big blue harvesters in the background. So that's where I kind of cut my teeth and became familiar with all the excitement that occurs on a dairy farm, putting out fires and chasing cattle and fixing equipment. And I'm pretty fortunate to get to work with dairy producers day in, day out now. Um, Pretty common across our team. Most people with an ag background and often still with their boots dirty out on the farm yet today, working with clients. Services we provide basically kind of start of the top of the stack with the dairy side is margin management, really pulling all of your commodities and financials together to help get a clear picture of your risk and opportunity. What we'll be focusing on today will be on the dairy and livestock insurance side, specifically LRP, livestock risk protection. That's a big and important piece of the puzzle for dairy producers to manage risk. We also work in the futures and options market, cash and physical commodities market. And we have a whole team that does managerial accounting, benchmarking, strategic advisory to kind of help the risk group get good numbers from clients so that we can give good advice. So that's what we're up to, how we come at the market. It's really from a hedging perspective and a risk management mindset. And we've got a lot of fun things to look at in the beef market. Sometimes the volatility is a little bit nerve wracking, but at least at this point, it's still hanging around record prices. So it gives us something really exciting to look at. So I guess that's the intro. I don't know if there's anything else that jumps out at you, Amber, before we launch in.
Well, I mean, I have one question. I know
You
folks,
bet.
if they're tuned in at this point, they're probably wanting to learn more to start with. But for
Hmm.
maybe those folks who are a little bit on the edge and they're like, we'll see what this is all about, give them like that one key off the top of why today is going to help their farm. I know that's
Yeah.
a big
Yeah.
question for what we're getting into, but that one key thing that'll help them stick around for a bit.
Well, I'll give Amber credit. She really knows the dairy industry because before we jumped on, she was curious about, well, how much of the margin and the revenue is driven by beef? And that actually is that one key. We had a little sneak peek at that slide and we're going to come back to it, but Amber nailed it. The key is the dairy business is now the dairy and beef business. They're conjoined at the hip. And that is the key. So why you should care today is that we spent a lot of time over many years thinking about how do we manage milk price risk? How do we manage feed price risk? How do we manage our margins? And beef was an afterthought, and that is no longer. And this is a great thing because the more you can diversify that revenue stream, the better off and more likely uh, the industry has a lot of room to grow and succeed. But we also have to be cautious and proactive when we're staring at record prices. We can't just leave that out there without making some decisions about what to do with them. So that's the heart of it. And I think that's a good setup to get going.
I think that's perfect. I'll let you get underway here, Will.
Okay, great. So when we think about getting to that punchline, we kind of build this up when we think about let's look first at what's been going on in the beef market. There's a lot of discussion, a lot of debate, but I wanted to zoom it way back and look at that. And then we'll take a little narrower slice in on cull cows and what has been going on in cull cows that's maybe similar or a little different than the much larger beef market. And then we're going to talk about LRP for cull cows. It's a tool that's been around, but it's not been used much. And there was a big improvement to it on July 1st this year, which makes it much more useful for all the dairy producers. And then we'll just give a very simple example of what can you do right now and how do you go through claims? How do you use the payments? How do you submit a claim? How do you capture and make use of the subsidy that's available to you? And then what do you need to do to get started? So that's the rundown. We'll go pretty quick through a lot of these and certainly welcome questions along the way or at the end. So beef fundamentals, first off, kind of start with prices because that's what catches everybody's attention. So again, if we think about what's happened in the last 3 months, it's been a roller coaster. It's been fading off of record highs, but I would say, hey, let's zoom out. Let's go back to 2010 in this example, or even let's go back to COVID. We don't like that price very much, but we're still up in the stratosphere here. This is right near record highs by any objective measure from a long-term perspective. These are fantastic cattle prices. We might have a little bit of heartburn about how they've been chopping around lately, but still at an excellent level. And to tie that back to cull cows, very similar story. Cull cows aren't necessarily the same grade, same use, same exact perfect correlation, but they're pretty much tagging along for the ride with this beef market. We are very close to record highs on cull cows. So that's been a big benefit for the dairies to catch the ride, not just on the cross calves, which we've covered separately, but also on the culls. So we think about, well, what's the cause of this? And there are many, many different causes. A simple way to look at it from a supply demand standpoint and really wind back 25 plus year window here, we're just running on fumes on beef cow inventory. See, we just don't have a lot of supply. And that's come from drought. That's come from economics. That's come from demographics. That's come from many different angles. But the point being is that we are at long-term lows on these inventories, and the demand has been good. The consumer wants beef. The consumer, in fact, is sort of obsessed with beef, even to the point that we're not seeing the switching out that you might expect to pork and poultry and other things. So we've created this supply constrained market where demand is held up, and it takes time to turn this herd around. So longest view, furthest zoomed out view, very low on beef cow inventory. And likewise, we're low on the calf crops. And I say, wow, this could last a while because you still need to replace that pipeline. It's pretty low. So the long run diagnostic is that this is pretty tight and it makes sense that we can support these high prices. Now they might be higher than we expect, than I would have expected if you asked me, say 5 years ago, could we get to this level? I wouldn't have believed the consumer could be this robust. But that's really good news for the dairy industry. And that's been the case so far. We don't know if that'll change, but so far they've really held up their end of the deal. Now, is there a turning point coming? You can see these charts. There's not a lot of data. There's some gaps when the government decides to shut down or lose funding or what have you. But we might be seeing a little bit of turning points. When we think about all cattle and calves, little bump higher on this July 1 report. Likewise on beef replacement heifers, little bump higher. The market is trying to solve this problem. We're starting to say, okay, the backdrop's pretty bullish. There's some signs that things are turning. And when we think about, well, where is the behavior in the marketplace and how are the participants responding? This is kind of like a little bit of an EKG on the beef industry. This is overall LRP premiums written, gross written premium. And we kind of highlighted a few of these major news announcements. And what you can see here is that the uptake and the demand for risk management and the demand for downside protection has really spiked on a number of occasions in the last, well, really 18 months or 2 years or so. And so many of these are policy driven stories. So I just say, hey, the beef market's on pins and needles out here. I kind of like how it looks, but it's a little dicey. And the first sign of trouble, people are running to get protection. And that could be most recently um, with the Tyson announcements, closing plants. It could be Liberation Day on tariffs. It could be DOJ probes on Packers. It could be the screwworm. It could be when Trump said we're going to do something about beef. It could be the Argentina tariff rate quota bump to allow more imports. Same with Brazil tariffs dropping. You can kind of see a list there. But there are many things that have been moving parts on the policy front that have really introduced a lot of policy risk. And any one of these or them in combination or something new could create a lot of risk in the market. So there's been a bullish backdrop. There's a few things turning, and participants, as you can see here, are quite nervous about the next big announcement might turn this cattle market on its head. So that's kind of the fundamental backdrop that we're coming into. Um, when we extend that, we say, okay, well, that's the beef market. Culls are a subset of it. Well, what's the outlook? What's the story on culls? And this is a little bit narrower corner of the market, but we can find some things that are useful to us. One would be this cutter cow cutout, which is kind of like a gross margin, if you will, or a margin structure that the processor has, and that's telling you, hey, they've been seeing a huge cutout. There's a lot of value here. Those culls go into this lean trim, which is kind of the beef value. That is way up in the stratosphere. You might even argue that that's not come off as much as the cattle price. So these are some pretty positive diagnostics on what's going on with culls and the beef value associated with culls. Um, Interestingly enough, the slaughter is down. So you'd kind of think, wow, with all this high beef value, wouldn't we get more slaughter? Well, you would think, but there's some other industry dynamics going on. One, everybody wants to retain a cow to get a drop calf because they're, as some people around here say, it's black gold. I mean, those are some very valuable animals. We want to keep any old cow that can stay in the barn upright and get us another cross calf. It could also be that there's a lot of milk processing expansion and people need to keep the herd up to fill that milk demand. So from a cull cow's perspective, the slaughter is actually down even though the values are up, which is kind of interesting. The other thing that's going on is the milk cow numbers are way up, which would tell you if you think about, well, what's the coal pipeline look like? Well, the coal pipeline is about as full as it's been because we haven't been culling much. And we've got this, whatever it is now, 33-year high, I think, on milk cows. So a lot of potential culls out there, but not yet hitting the market. Um, Now we kind of think about turning points, like we talked on the beef side. We're seeing a little bit of a turning point on heifer replacements for dairy. So you start to wonder, hey, this all looks good for culls up to this point, but then you kind of put your risk lens on and say, well, if we've got a very aged herd, ton of retention, 30 plus year highs in milk cow numbers, and heifers turning up, could you see a flood of culls hit the market? Quite possibly. We don't know what will trigger that or when, but it's definitely a risk that's hanging out there. So when we think about what's going on in this market, there are definitely some supportive things. I don't want to minimize that by any means. I think in a lot of cases, there are many strong arguments for beef staying, at high prices for quite a while here. We still have that very small herd overall. The beef value, the consumer demand is quite good. The pipeline's tight, even if it's turning. We all know it takes a long time to get a cow to market. So those are kind of things that are working in favor of the cull cow market. On the other hand, with risks, the consumer is stretched here a bit. Inflation is still going. Fuel prices are still high. Probably pushing on a rope here a little bit is how much further we can push beef prices. So far, so good, but it feels like we're running into some resistance. Packer margins, capacity constraints, that goes back to that one policy slide where we're seeing kind of the EKG signals there. I mean, the Packers have been struggling. They've been losing money. The publicly reported numbers are quite poor. Tyson shutting down plants, selling plants. That's been tough, and that's hard when you lose demand from the processor side. We've had the border, the screwworm, disease issues, trade issues, all those things present risk. If the border opens up, the screwworm is managed, there's a huge potential flood of inbound feeders from Mexico there. Um, and if that results in things rebuilding quicker than expected, you got a lot of risk. And then we looked at there's kind of that overhang on the big milk cow herd and the heifer supply. So I think you could probably, if we tried hard, we could stack these lists up and rank them, and maybe we'd find more in the supportive category or not. I think for now we see that it's a pretty decent situation, but we got to be cognizant of these risks.
So, Will, before we
Yeah,
really move into the LRP portion, we did have a question come in
you
regards
bet.
beef prices overall, or well, not necessarily prices, that I wouldn't say, but this question reads, how much of the current beef market is from beef on dairy cross calves? Do you
It's
have that
still,
information?
yeah, I don't have it on the slide here. I mean, it's in the single digits. It's definitely growing. Um, it's a spot that it as the milk cow herd gets bigger, there certainly can be more contribution. I think if we just pull our client base, the vast majority are breeding in that direction. And it's more the exception when I talk to someone that's saying, I'm trying to, you know, boost, my heifer inventory, or I want to take the other side of this and try to sell into that market, or oh, I'm only doing half on crosses or whatever. So those are the ones that kind of catch me off guard when I hear it because they're less common. I do not have the hard number, but I can certainly get it out here and share it separately. But we're talking single digit percentages overall.
Okay. Good to know as we continue on here. And thank you for the question for whoever typed in. But I'll let you keep going here, Will.
You bet. So this is the part where we say, okay, well, that's interesting. Dust off the crystal ball. Where are we going with this? I think if the crystal ball is accurate, we wouldn't be worrying too much about the value of these cows, and that's why we want to use some of these risk management tools. So the big question is again is, well, how long can this last? I see now that this is available to me. What can I do specifically, and when should I do it? How should I put a floor out there? And I think those are really the right questions to ask. And it goes back into kind of the overall risk management philosophy of that risk management is not just defending against the bad times. You can see that there's a flood of insurance business got done when people got scared. That wasn't really a proactive approach. That was kind of a reactive approach, right? And sometimes you need to get a little kick in the rear end to get off the fence and get something done, and that's understandable. But in a lot of cases, we want to look out here and be a little more objective and say, hey, if we're up at these high prices, let's take the part of the risk management equation that says I want to capture opportunity. And that's where we can become a little bit more agnostic about, well, how's this going to play out? We know it's a good opportunity. What can we do to capture it right now? And that's really where LRP is coming in today. So the big thing with this tool, which we really like and how it kind of fits this time, is that it gives you downside protection. So we're going to set a floor. It gives us a lot of reach. We can go up to 52 weeks forward. This was that big change I was talking about. In July 1, it went from only a 13-week reach to a 52-week reach. And that's where the usage is really kicked in. And that's where it's really kicked in from our standpoint, working with dairies all around the country, is that, well, 13 weeks is okay, but we want to be more proactive. If we want to protect ourselves against a big reversal in the market, we really want to be out in the next year doing it. So that was a good change. The other thing here is that let's say that you want to argue, and I'm happy to take either side of that argument because I can see plenty of upside left too. But let's say you feel more strongly that there's upside left in this market. The beauty of this tool is that you've got the upside open less your premium. And the last part, when it comes to the finances, USDA is showing up 35 to 55% of the premium for you on a subsidized basis. A lot of our clients are kind of in that 40-ish% range, depending on the coverage level they choose. If you're new and you're a beginning farmer or rancher, there's another 10% plus or so available depending on the particulars. So it can be very low cost that way. And then we don't pay till the end of the period. And we actually pay way past the end of the period. We'll show how that works in a little bit. So it's got a lot of benefits here where we can set that floor, we can take advantage of where we're at today, we can leave the upside open, we use the government's money to get the job done, which makes it pretty attractive. So when we think about how it works specifically, we kind of looked at the Cull cow price itself is at a very high level, but there's not a futures market for cull cows, right? So the next step is, well, what are we going to use to manage this risk? Well, we could use feeder cattle, we could use fed cattle, we could use futures and options. The way the LRP works is that we're working off the feeder futures or the feeder price. And you can see that's a nice correlation here. You can dust off your old statistics book and see it's a pretty nice line. Is it perfect? No. Is it a solid correlation? I would argue yes. Is it going to hold up perfect in a downturn? I think it's going to be pretty good, but only time will tell. The main point there is that it's a flexible tool. We're coming at this to try to catch the downside. We're not trying to get that basis risk down to the last nickel. We're trying to say, do we have a good enough fit to have a tool that's going to work for me if the market really takes a hard dive? And I think, the intuition here would be that this should help out that way. So we're setting a minimum. We're using the feeder and we're using a multiplier that RMA sets to drive it back towards a cull value. And this is where we say, okay, we've got those features and benefits. We see how it kind of fits up. And now the punchline that Amber alluded to earlier, why, again, tell me, why do we care? I know beef is high, but what's going on with my actual revenue, my actual profit, my actual margin on the dairy? And if you wind the clock back, we've got noted here like pre-COVID, you can see that the beef revenue was almost all from culls. Very little was coming from those bull calf sales. And then it started to climb over time, and then it really accelerated as beef prices took off and cross calves took off. So these revenue contributions are huge. Whether you want to say it's a 17, 18, $19 milk market, you go from $1 to $2 of revenue from beef to $5 or $6 of revenue from beef. A very large percent of that revenue on the dairy is now contributed by the beef market. And likewise, let's say your margins are $1, $2, $3, $4, 100 net. I'll let you draw your own conclusions about what percent of that's actually coming from beef. That might be enough to get you very interested in cull cow and cross calf LRP. So that's what we're trying to protect with the tool. And this is a quick snapshot to show that protection has drawn interest in the market. So the gold color is a cull calf LRP going back a year or so. And this is monthly premium for the whole industry, everybody reporting back to RMA. Just a little bit getting done all the time. The green is the cross calves, plenty of usage there. And then July 1, when this became available, a whole slug of people came in and said, okay, good, I can finally use this. And that was definitely the sentiment in our customer base. And then even as we're only partway through August, you can see the culls and the crosses are about the same premium. So this is a good trend. It's getting adoption. This isn't just an idea like, oh, well, did we make a product that no one wants to use? Well, that was kind of the first pass at it. But now I would say, hey, this is a good tool because it was made in a good way. It just didn't let us reach far enough. Now it does, and you can see the industry starting to pick it up. And you can see it's kind of picking it up as a whole. This is the percent of the cross calf and cull cow premium versus the entire LRP premium, which is your traditional beef market. You're getting a pretty good, north of 10%, closing on 20% of the total premium is moving in these products. So it's a lot of interest, which is good to see on the last whole month that we have there. So that's a little bit how it works. It's a little bit how the adoption's going. Now the question is, well, let's look at an example. What can I actually get today with it, right? So this is kind of our quote tool and how we like to look at the market. There are many ways to spec this out, but this I feel is a pretty good example. We'll use a dairy that's on average selling about 100 head a month. We see all kinds of weights out there. I think 1,400 pounds is kind of in the middle there for what's pretty common for folks running Holsteins. You can adjust the weight down if you got jerseys. You can adjust the weight up if you're got big frame cows and you hang on to them longer or whatever it may be. There's some wiggle room there. But this is a fairly good example of what we're looking at. And just to go through the two highlighted bars, the first one would be, hey, let's say I'm interested in this today. I want to take a first bite. I want to see how this works. Let's go get something out into next year. We can take a February end date, 215 end date. We can cover 100 head. The current projected price is around 2,000 bucks a head. That's taking the feeder cattle price looking forward and running it through that correlation to say, what is a cull cow worth? And that, talking to people around the country and what they're getting when these cattle are picked up, these have been quite reasonable and pretty on target. There are many different coverage levels you can choose. We kind of like this 93 or 92.5%. It hits around that 40% subsidy. So you got a lot of Uncle Sam's money coming in on that premium for you there. And you can set a floor at 1871. If cull cow prices get cut in half, your minimum's 1871. It costs you $35 and change a head to get there. If cull cow prices go to $3,000 because the whole world is just humming and stock market's record high and the consumer's buying all the beef and it takes forever to rebuild the herd and every dairy benefits from it, great. You're out 35 bucks a premium. And I can guarantee you're not going to miss it if you're seeing, new record highs on cull cows. If you take a shot at this to get caught up on a whole slug of protection, on average right now, all the way out to next August, it's still north of $2,000 a head projected price. You can cover north of $1,900 a head minimum, 1923 minimum. And it costs you just around 45 bucks a head to do it. Very reasonable, very cost-effective way to get some protection. So this is kind of the in the weeds details on how each of those work. It's kind of a rehash, but I think the big thing to think about is that those forward prices give you an idea, and they should look something like what you're seeing out the door today, and they should correlate back into what the futures market is showing on feeders, and then the RMA's correlations that they feed in and their multipliers. You can see where these protection levels are. You could go up to 100% if you want. The premium's just going to get higher. This is just an example. And, subsidy in there is helping keep the costs down. I'll kind of avoid, we've got other presentations and I'm happy to talk anytime about, more specifics on how that minimum works. But I think it's pretty simple in this case. It's minimum price insurance. Set a floor. If you go through the floor, you're covered at that level. Price rises, you're out your premium. Then the question comes, well, okay, how do I get a claim if that bad situation happens and the market drops sharply? So basically what happens is we wait till USA publishes the ending values. We have to sell the cattle plus or minus 60 days of that end date. So we've actually got a ton of flexibility when you market the cattle. So we got a lot of wiggle room to get that average number ahead right. We'll queue up a DocuSign, send that off to you. You fill in the details, AIP reviews it, and if it's all clean and neat, you get your payment issued. What you need to do is you got to make sure that when you're selling these, it matches your insured name for the entity, and then you got to catch the details on who's buying these cattle. Pretty much any of your other normal herd data is good for record retention on an audit, but these are the key things to keep on hand. So pretty basic records. Most everybody has that when they're selling cull cows, so it's nothing too burdensome. You just want to hang on to them and be ready to go if the market's dropping sharply. The other thing that I kind of mentioned briefly is not only is the government paying a portion of the premium through subsidy, when you get the coverage and you sign an endorsement to get coverage, if you do it today, you don't have to send the premium in till later. So in this example, we say, hey, let's cover some cattle, some culls out to March 27. And let's hope during that time market goes up, cash beef goes up, LRP policy is done, no claim, you owe the premium. Well, you won't even be billed until April. because it's after the end of the period, and then it's not actually due till the end of May. So you can get coverage in August for cattle out into March, and you're paying in May. So your banker will be pretty happy that you're not tapping that operating line to cover these cattle. So pretty nice feature here. It's probably even a little undervalued in people's mind. You got cost of money is pretty high these days with interest rates up and operating lines being expensive. This is just kind of another nice feature of how LRP works to save you some money and keep the cash flows nice and clean. Um,
Will,
so,
before we
yep.
get too far past, in the last section here, about two
Hmm.
slides ago, you had a question, I think answered this question, but I do
Yep.
also want to make a comment there that it is nice that, it basically covers itself, the cost of the program. It's not that you have to worry about some upfront cost or
Right.
way down the line. So want to make a comment there. But also, we have a question from a listener, and I
Hmm.
think you pretty much answered it, but just want to clarify here. So this question reads, so from your examples from previous slides, if I sell 100 cows, I'm picking a month to do so and need to sell in that time frame. But then we moved ahead a slide. Is that 60 days plus or minus? Can you just go into that for a minute
Yeah,
there?
that's actually a really good question because that's one of the more nuanced things about LRP being different than DRP. So if you're familiar with DRP, you kind of know that DRP covers you for a quarterly period and you market milk every day during the month, and the USDA settles out your milk check against the month average, and then your DRP settles out against the average of those 3 months in the quarter. So it's kind of this whole long averaging story. With LRP, the way it works is that we have these rolling weekly periods where the LRP is offered a certain number of weeks forward. So in this case, 13 to 52 forward. And for the example, I picked 26 weeks forward, which basically is Feb 15 of 27 right now. Tomorrow it'll be another day out and another day out and another day out until the weeks kind of catch up, if that makes sense. So in a lot of cases, what we're trying to do with these is we're trying to match up the positions with the expected number head that'll be marketed in a calendar month, because that's usually how we're thinking about it. We're saying, well, I've got my I've got my breeding program and I've got my timelines that the truck comes to the farm and I've got these certain things. On average, maybe I sell 100 a month. So what we can do is you can have one endorsement that covers the whole month. Like this 215 is kind of nice because it's right in the middle. And we can reach forward and back 60 days to pick up records to show that you had the cattle in order to make the claim. So there's a lot of flexibility in it. Generally, just kind of best practice is to try to either get in the middle of the month or to spread some endorsements out throughout the month, or to possibly just reach to the end date of the month so you're covered through the whole calendar month. People have different views on that, but the big thing is you want to try to make sure that you're sort of targeting your end dates in a way that makes sense for what you're doing in your operation. And usually the easiest way to get there is to kind of take your average monthly flow and then maybe one or two, depending on how many bites you want to take on coverage, get that protected. And then when it comes claims time, what we're always going to do is we're going to try and make it as advantageous as possible, reaching forward or back in that 60-day window to pick up those records. Now, you can't ever double count. So if you reach back or you reach forward, those cattle are going to be tied out to an end date when you make your claim, and then you can't go make another claim, right? Can't go pick up two checks saying you crashed your truck twice. So that's not allowed. But there's a ton of flexibility here. Um, Sometimes I think, oh, it'd be just easier if they made it like average across the month. But hey, if they're willing to give you plus or minus 60 days, I think you should just take it, and we'll help you with the paperwork on making sure you pick up the right cattle plus or minus 60 days of the end date.
So, Will, to go off of that, then, I hate to go worst case scenario on you,
Sure.
but gosh, what if you are in that unfortunate situation where you're like, I've got 95 head that I was able to put through, but I wasn't able to meet my 100. What
Hmm.
happens then?
Well, If you have sequential months covered, you could probably beg, borrow, and steal in that 60-day window from either side, depending. So that's an option. That does run out in the end. If it turns out that you only marketed 95 and you only chose one end date, um, you're going to be out your premium on those five head. Now, is that the end of the world? Probably not. It's going to be a very small amount on a percentage basis. And if you're getting a claim, you're probably happier that you're getting a claim. I think in most cases, very similar to DRP. And really, if we think about how our clients have used these tools, we're reaching out, we're covering multiple months. So we're gonna have a pretty nice buffer to be able to, as I say, kind of beg, borrow, and steal in that 60-day window to cover that shortfall five head. And if we can't cover it, I don't think you're going to sweat it too much. It's going to be, I'll mess up the numbers on the fly on a webinar here, but if I whip my calculator out, it's going to be some very small percent difference to lose five out of 100 and pick up the claim on the rest.
But I think it's a good point to make that,
Mhm.
don't be doing some wild numbers because you're still going to have to find it out there somewhere,
Right. And
or you're
and I
going to
think
pay
I
for it.
think some clients look at it that way where they say, I don't ever want to be in that situation. And they'll tell us, let's just cover 80 or 90% or 95%.
Mm.
And then I have other people say, well, I'll just do 100 and I'll just let the window sort it out. I'm sympathetic to whatever makes you more comfortable. I definitely don't like spending premium that's not going to work. I think that the 6-day window gives you a ton of flexibility. But if you kind of look at and say, you know what, I looked and we worked through these dairy comp records and sales sheets and everything, and I definitely see it. There's waves, in how many go to town in a given month, and sometimes that it's just the truck showed up on the Wednesdays and the first and the 31st are a different day, and you're out of whack. But there's a lot of ways to make sure that you can fit it pretty clean there.
Well, and I think one thing that's really advantageous for a lot of dairy farmers is, yes, this might be a little bit different than DRP, where you kind of know a little bit more consistently where you're at on the milk
Mhm.
side of things. But given the amount of records and data that we have nowadays for knowing who's calving in, how many springers and replacements we have, that gives us a lot of ability to project and see out that
Yeah.
we might not have had or thought about 5, 10 years ago.
That's right. And people are definitely getting better at that. And I see it, especially on the cross cap side. I mean, those projections have been solid for most people. And you'll get weather events, you get a few odds and ends that disrupt it a bit. But yeah, I think most people can make a pretty solid projection around this. And if you want a little breathing room, do 90%, you should be in the clear.
Okay, perfect. I'll let you keep going on. We
Yeah.
answered the question for now, and then I got us on a side tangent, but I'll let you go to your last section here.
Yeah, that was actually a very good question because it highlights a difference. And in some ways, I don't often go too much into that flexibility, but it is a nice little benefit of the program. Um, so I guess the last item, this is something that's pretty easy to get started with. I think like anything that's new, I always tell people don't feel bad about dipping your toes in the water. Um, I think if you sit on the fence and it's all academic, it's hard to learn it. If you want to learn by doing, this is a pretty low risk way to do so, is you can jump in here. You get set up with a policy. It doesn't obligate you to do anything, but then you're ready to go. Usually work through that info gathering questionnaire, kind of like we're talking now, where, hey, let's look at those reports. Let's figure out your flows. Let's look at that variance and how many you're sending to town. And then let's talk through, we showed the example of the 93% level, but let's walk through all the different levels. Let's talk about the weights. Let's talk about your average weights and how we want to get this to fit for you. And then when it's time to pull a trigger, if you've been using puts over the years, you've been using DRP over the years, it's quite simple to add coverage with this. I kind of gave a quick snapshot of the quote platform there. That's something that helps people go through those scenarios quickly. There are many, many ways to set up the parameters here. We can get it dialed in and help you figure out what's best for your goals. And then also we can help keep tabs on these as they move through marking them in market as time unfolds and then managing through those claims windows. So that's a pretty important piece of the puzzle, is that we don't want to just kind of sign the DocuSign and put on a shelf. We want to be able to keep tabs of it and help it feed into all of our other risk management decisions. So that's something we do with clients. Um, so I guess to sort of wrap this up, what's the big summary here? I think the first part is that, we just have to be mindful of the opportunity and the risk that's out here. We gotta recognize the moment we're in. There's a ton of opportunity near high prices. There's also a risk. We've seen the volatility. We've seen a little slide lately. We've seen the panics around these different announcements. And look, they might be justified. When you get to high levels, all the market forces are showing up for those high prices to cure those high prices. And sometimes it just takes a few policy, things to come in and prick that bubble, and then we're moving into a new regime. So love where we're at. The risk is high as well. You have to understand that things have changed. This isn't 2019 anymore. Beef value is a big, big driver of profitability, and consequently, we don't want to let that slip away. And then when we start going through what's available to us, we always say, hey, let's use the best available tool. I'm very agnostic. Is it the cash market? Is it futures and options? Is it an LRP or DRP product? Let's make sure we understand how all of those work and what's available to us. Can you sell fixed price cull cows 12 months out at record prices? You tell me. I haven't seen much of it. Be pretty cool if you could, but what's another alternative? Well, enter LRP. So all these tools have a different place when they can be used. We feel like LRP is kind of in its moment right now where it's very simple, very cost effective, a lot of regret minimization there. If prices keep running higher, let's hope they do. But if they don't, this is a way to capture them where they're at. So feels like there's a lot of things that are all kind of converging. Timing's been good. Appreciate RMA and the program minister and everybody who made the tweak to make this work better for dairies. And now it just comes down to everybody, who hasn't used it, take the time to understand it, see how it fits in. We're always happy to answer questions. Appreciate Amber and your team bringing these new things out for people to learn about them. And I'll just leave it at that.
Well, Will, I won't let you go here quite yet because I've got, I think, one of the interesting questions that's on a lot of producers' minds right now, especially knowing where beef prices are at. And this is not necessarily strictly on the cull cow side where I'm going with this question, but in general. We know that like next week with the border opening in Arizona for some more animals coming across and able to enter the meat market, how do you think that's going to, or has it impacted some of your clients' views on what they're going to be doing long term here? I know this is 100% an opinion, but
Mm-hmm.
do you think that we need to be a little bit more aware right now of maybe prices that have potential to be a little more volatile in the next few months or, well, year even?
Yeah, I think that those types of things have made people more proactive. There's always a debate, well, to what degree is it known the border is going to open, or to what degree is it known that this new fly plant's going to show up, and to what degree was it known that Tyson would announce the closure? Maybe there's some degree that that's baked in, maybe not, but you also can't ignore when it starts to happen that creates a cascade where if a huge source of feeders into the US is Mexican feeders and they're locked out, it's a crystal clear way to tighten up the market. The market can digest the rate and the change and the likelihood that that sticks. But once it starts going, it's somewhat inevitable that it's going to change the supply and demand balance. So as each of those things that kind of chip away at a bull market, they can really knock the price down, because if you're on the other side and you say, well, how nervous should I be and how aggressively should I be buying and bidding and staying ahead of this beef market because I'm terrified it's going to keep going higher? Well, they're sitting there at their desk too saying, well, it looks a little bit better for me. Maybe I need to lay off a little, right? So, every market has got two sides to it. And as these things happen, it starts to take some of the enthusiasm out. And that's where I think people are right to say, look, we're still near the top. This is a little more dangerous. Let's push that coverage way out. And I've been pretty unapologetic kind of on my view. I mean, everyone has their different situation, but I'll say that it doesn't hurt my feelings to get the maximum reach on cross calves and on cull cows, just given the circumstances. You could take a longer look at this thing, and I don't know, 10 years from now, we may look back and say, man, that really was a true 10-year high. What we're doing, not not being aggressive here. And I think with a minimum price tool, you don't even have to be right. You just have to be willing to engage, set a minimum. And if you're wrong about it turning, you still have the upside anyway.
I think that's a really great way to look at it, especially right now where there is opportunity in this market. And I know, for example, on the cull cow side, it's not a one-to-one change with what goes directly on with feeders, but still, it's a thought process of, gosh, prices. I mean, we know the volatility of milk prices. Why not be able to also manage something that has become so important to the bottom line of a dairy? So, uh, that was the last question I had. And I know that was a kind of a crystal ball. Give me your insight and your opinion on that one because it is. There's so many other factors that'll happen in the next, year that could impact beef prices. But this is currently one that a lot of people are talking about. And if it gets people to maybe try something, dabble in it a little bit and see what it does for their farm, there's no harm in that. So Will, with all of that being said, as we kind of begin to wrap up here today, I know you mentioned it a little bit earlier, but what's your drive home or key takeaway that you want producers to be thinking about or actively doing after today's discussion?
Yeah, I'll just go back to the one because I like this chart so much and you asked about it. So we'll just hit it three more times. Um, this is a monumental change in the industry. This is one of the biggest things that's happened in a long time. And you got to put the pencil to paper on it to understand it, track it, recognize what it's doing for revenue and margin, and then think about how do you not let it slip out of your hands. So this is great news. I mean, I could take that last question that the person online had and say, well, long term, what's going on? Well, long term, I think this is one of the best things happening too, is that to get the dairy industry hooked into the beef industry in a deep way is fantastic. I don't think that's going to change. The part I know will change is that these prices are going to go up and down. They always do. We just don't know when, and we want to be prepared for it. So that's you know, the big item for people to really think about and to think about how can they become proactive around that.
I think that is the perfect way to end today's episode. So thank you so much again, Will, for all of your time and insight today. I know we didn't know it was going to be quite this timely, but it is very timely given everything that's happening beef price wise. So just thank you so much for your time here this afternoon.
Thank you for the opportunity.
I want to say thank you again to those who joined us and asked questions live. Always appreciate your interaction. And also for those who are wondering, gosh, what is going on with professional dairy producers? I haven't seen you guys in a minute. Well, we've got some great things coming up, including next week. We have our Ace on the Farm Twilight meetings. They are August 24th through the 27th. 4 different days, 4 different evening locations and times that you can check out on our website to learn more about where in Wisconsin we'll be. We'll be talking with Wisconsin's towns, Wisconsin counties, talking with your neighbors, your local elected leaders to really just dive into what's going on in your area. So make sure to join us. Farm tours, free ice cream, great community discussion, and we hope to see you there. But for now, have a great rest of your Tuesday, and we'll see you here Thursday on the Dairy Signal. Bye now.